Good morning, Michael. Thank you for coming. You just submitted your article to Wall Street Journal, online version we were talking about. What was it?
So, while everyone is focused on Dow 14,000, I've been making the case for the past week and a half, that we actually should be maybe more worried about Dow 13,000. Let's talk about what's happened so far this year. We entered 2013 with everyone being very worried about the fiscal cliff and everyone thinking that you would have a collapse because a deal would not get done. A deal got done, and you had one of the best Januaries in U.S. markets, basically in over a decade. However, that excitement in the stock market was very U.S.-centric. You did not see similar outperformance, similar strength in emerging markets, and really not so much movement in Europe. So you had this kind of very focused type of stock market move here in the U.S. Now, there are what I call a lot of nouveau bulls, new bulls, like nouveau riche from French days. The issue that I'm seeing here is that a lot of people are under this assumption that stocks simply cannot go down. We just had the best year since 2009 and 2012, and within the market, there are a lot of concerning behavioral price movements taking place. What do I mean by that? In the article today, what I stress is gold relative to the S&P 500. That relationship appears to be stabilizing. Gold tends to underperform stocks when actually you have a good environment for equities. It tends to underperform when stocks are supposed to be doing well because there's inflation expectations coming in. This time around, gold is stabilizing, meaning that maybe gold buyers are starting to be a little bit nervous that you could see a correction, that you could see a deflationary scare in the very near term.
So are you saying we're going to see a correction?
It seems that we are primed for a surprise decline, and it's happening just in time. Dow 14,000, Europe is coming back into the headlines, and this universal belief that equities are going to go higher and higher and higher. I don't disagree that by the end of the year you'll see higher stock prices, but between now and then you can very easily have a scary drop.
So while everyone, including Jim O'Neill, the famous Goldman Sachs chairman, says that everything in terms of the rest of the year, in terms of the equity market, is going to go up. For the rest of the year, the stock market is going to make us happy. While he says that and everyone else says that, you say that there's going to be a correction, we're going to see a downward trend. How much do you expect us to see that? How much do you expect to see when we talk about going downwards? S&P 500, Dow Jones.
So just by way of example, last year we had two mini corrections, April to May and October to mid-November. Now, those corrections were small, because the deeper stocks declined, the more their dividend yields rose relative to treasuries, which were back then at historically low levels. This time around, yields have actually risen in the bond market, and dividend yields have fallen. So there's less of a cushion in terms of how much stocks could fall. So I think you could see something deeper than, if it does get worse as I'm seeing it, something deeper than what we experienced last year. Simply because now, if you don't have companies really increase dividends, if you don't have follow-through of growth, it's kind of a show-me situation. The market wants to see that these prices are legitimate and that the rise in the bond market in terms of yields is justified. I think Dow 13,000 can very easily happen. Could it go below that? Absolutely.
How much?
I think Dow 13,000 absolutely could happen.
It could happen.
But I think, and it could happen very shortly. Below that will very much depend on if Europe now becomes another problem, if it starts to haunt a lot of these nouveau bulls, just as everyone's getting bullish.
How about S&P 500, you said?
Yeah, S&P 500, it's going to be roughly, let's say, a 10% type decline.
10%. Yeah. Okay, so we're talking about Dow Jones, 13?
Right, 13, let's say roughly 13,000. I think as an initial, if you want to call it a target, because again, a lot of these intermarket trends are suggesting
So
that's
we're not going to be holding on to the 14,000 that we were very happy to see.
At least I think for now, and it's not me, and this is based on price interpretation. The market itself is not confirming cyclical excitement. Emerging markets are weak, industrials look exhausted, utilities, consumer staples, and healthcare, those sectors which lead in a bear market are starting to outperform. And we have to be very, very careful about this great reallocation, this idea of bonds, money coming out and going into stocks. If yields in the U.S. rise too fast, it's going to choke off the recovery.
But the companies did pay the dividends, and that's why we saw an increase in the personal consumption. Remember last week and the week
And
before?
income as well, right?
And income as well. And that's why we also were a little happy with economic data, and then the economy, also the U.S. economy.
Right.
You're not happy with that?
No. Well, I think actually that rush of special dividends in December might explain some of the powerful move in January, because
Okay.
it essentially got reinvested into broad market stock averages. That's why we saw, I think, a lot of these mutual fund flows into stocks have actually increased week to week. There is, I think, little doubt that the economy is improving, but there is something that is concerning market internals. It is never clear what it is. It could be Europe.
It could be.
It could be oil.
Okay. And Standard & Poor's, last question. We have very little time left. But this is a big scandal, but this is overdue. What do you think about all these charges from the Attorney General against Standard & Poor's? Where is it going to go?
Yeah, I mean, it's probably about time, and I think it's kind of unfortunate that it takes so long for these things to actually come to court. But I suspect that this can be a much bigger situation, meaning that you've had now 4+ years since the crisis. Now it seems that so maybe S&P is kind of the first to kind of get focused on, and then you might see others, Moody's potentially maybe gets in the crossfire as well.
Thank you so much for coming today. We're going to have you again. Thanks,
Thank you.
Michael.